Austin's post-pandemic real estate market carries the reputation of an overheated engine. Current sentiment assumes that engine has stalled and the market is in freefall. To diagnose the actual macroeconomic reality of Austin in Q2 2026, we have to bypass sentiment and examine the empirical data. Our primary diagnostic tool for this analysis is the activity index. This table outlines market phases based on activity levels. Currently, Austin is operating at an activity index of 24.1%. This places Austin in the softening band, defined by slower sales and rising inventory. This remains above the contraction and crisis zones below it. The central question for this analysis is what specific behavioral inputs are keeping this market successfully afloat at 24.1% instead of stalling into contraction. That 24.1% is a precarious mathematical equilibrium maintained by highly specific seller behaviors that we must now deconstruct. Before dissecting the metrics, we have to ground the data in the physical scale of the Austin metropolitan statistical area. Within this footprint, individual neighborhood indices fluctuate, but our focus is the macro-level systemic health of the entire region. To gauge that macro health, we must start at the most obvious pressure point, the supply-side curve. While total volume attracts headlines, the actual pressure point was the historical speed of inventory accumulation. Right now, active residential inventory in Austin sits at 16,264 units. This chart displays the multi-year macro view of active residential listings, showing aggressive upward waves of inventory accumulating since early 2022. The market reached a massive peak in July 2024 at 15,503 units and set a record ceiling in June 2025 at 18,146 units. Analyzing the current trajectory requires moving beyond total volume to look at the rate of change. This line graph isolates year-over-year pacing for 2024, 2025, and 2026. The wide gap between the gray 2024 line and red 2025 line represents rapid, volatile inventory accumulation. However, the dark blue 2026 line tightly hugs the 2025 trajectory. At this point in the year, 2026 active listings are only pacing 1.1% higher than in 2025. That 1.1% metric proves the supply curve is decelerating. It is flattening out, which significantly reduces the probability of the market breaching the previous 18,146 unit peak. While inventory remains structurally high, the rapid accumulation has stopped. The supply side has entered a plateau, removing the immediate threat of runaway inventory. Even with a flattened supply curve, the market dynamics still favor the buyer due to the liquidity gap. Every market is a continuous tug-of-war. New inventory pours in on one side, while pending contracts drain it on the other. When the inflow outpaces the outflow, it results in a persistent pool of excess volume. This chart tracks the cumulative difference between new listings and pending sales. For 2026, blue new listings are tracking significantly higher than yellow pending sales, creating an exact surplus of 2,772 properties without a corresponding buyer. A sustained surplus of nearly 3,000 units strips away seller leverage. Buyers in this environment utilize the luxury of time and excess choices to dictate contract terms. Facing this 2,772 unit surplus, sellers are forced to use the only mechanism left to attract an offer: aggressive price elasticity. Widespread price cuts are often mistaken for the beginning of a market crash. This table breaks down the price activity for all active listings across the Austin MLS. Looking at the top-line metric for the entire MLS, 47.6% of all active listings have executed at least one price drop. In a rigid market, sellers refuse to adjust their prices, forcing the market into a true contraction phase where transaction volume freezes entirely. The Austin data demonstrates extreme elasticity. Sellers are reading the 2,772 unit surplus and voluntarily adjusting their numbers to meet the market clearing price. We can see the result of this elasticity by examining transaction volume via pending listings. The blue line representing 2026 is tracking higher than the red 2025 line throughout the spring. Year-over-year pending sales have increased by 4.8%. That 47.6% price drop rate is the engine powering this 4.8% increase in executed contracts. Without these price reductions, those 5,166 pending contracts would not exist, and the market would have completely stalled. Record-high price drops act as the clearing mechanism for a functioning, liquid market to process its excess inventory. This brings our analysis full circle back to the 24.1% activity index. This index is supported first by a decelerating supply side, with active inventory pacing at just 1.1%. The second variable is the seller elasticity mechanism, operating at a 47.6% reduction rate. The third variable is the resulting liquidity, a 4.8% year-over-year increase in pending sales. As long as these three variables remain in this ratio, the market will sustain this 24.1% softening equilibrium. The key metric for Q3 is the price drop percentage. If seller elasticity hardens and sellers refuse to negotiate, pending sales will drop, and the market will cross the threshold into a true contraction. The Austin Q2 2026 data reflects a highly rational, elastic market successfully navigating a structural supply surplus.